stocks that have always been price, not value. That doesn't mean that somebody who cares about value cannot hold them. Nvidia would basically have to decimate or dominate the entire AI market for it to be justifying this price, and I'm not willing to take that bet. I mean, there's too little upside left when you price that in.
Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
In this video, let's look at the summary of Professor Aswath Damodaran's latest views on Nvidia company. The stock is up nearly 200% so far this year. This is part 1 of a 2-part video series on this topic. Before we start, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos. Professor Damodaran starts his review by sharing that he would like to make a couple of confessions. The first is that his portfolio has held up well this year, in a market that has been top-heavy and tech-driven, and one big reason is that it contains both Nvidia and Microsoft, two companies that have benefited from the AI story. The second is that much as he would like to claim credit for foresight and forward thinking, AI was not even a speck in his imagination when he bought these stocks, Microsoft in 2014 and Nvidia in 2018. He just happened to be in the right place at the right time, a reminder again that being lucky often beats being smart, at least in markets. But NVDA's soaring stock price has left him facing that question of whether to cash out, or let his money ride, and thus requires an assessment of how the promise of AI plays out in its value. He covers his views in 4 parts: Semiconductor, the business; Nvidia, the opportunist; AI, from promise to profits; and Nvidia, valuation. Let's cover each briefly. Semiconductor, the business. The semiconductor business, in its current form, had its growth spurred as a consequence of the PC revolution of the 1980s. As personal computers transitioned from tools and playthings for geeks to everyday work instruments for the rest of us. In the last 4 decades, computer chips have become part of almost everything we use, from appliances to automobiles, and the companies that manufacture these chips have seen their fortunes rise, and sometimes be put at risk, as technology shifts. From close to nothing at the start of the 1980s, revenues at semiconductor companies surged in the 1980s and 1990s, first boosted by the PC business and then by the dot-com boom. The semiconductor business has generally been a profitable one for much of its existence. While gross and operating margins have always been healthy, there are cycles of profitability that have continued, even as the business has matured. As the semiconductor business has acquired heft, in terms of revenues and profitability, investors have priced those operating results into the market capitalization assigned to these companies. As the semiconductor business has matured, it has also changed in terms of both the biggest players in the business, as well as the largest customers for its products. The cast of players has changed over time, with only 2 companies from the 1990 list, Intel and Texas Instruments, making it to the 2023 list. Over the decades, the Japanese companies on the list have slipped down or disappeared, to be replaced by Korean and Taiwanese firms, with Taiwan Semiconductors being the biggest mover, moving to the top of the list in 2022. The customers for semiconductor chips have also changed over time, with the shift away from personal computers to smartphones, with demand emerging from automobile, crypto and gaming companies in the last decade. Nvidia, the opportunist. Nvidia was founded in 1993 by Jensen Huang, but it remained a niche player until the early parts of this century. Much of its rise has come in the last decade, just as revenues for the overall semiconductor business were starting to level off. Nvidia went public in January 22, 1999, with the dot-com boom well underway, and its stock price popped by 64% on the offering date. There are 2 impressive components to NVDA's history. The first is that it has been able to maintain impressive growth, even as the industry saw a slowing of revenue growth between 2011 to 2020. The second is that this high revenue growth has been accompanied not just with profits, but with above-average profitability, as NVIDIA's gross and operating margins have run ahead of industry averages. NVIDIA's core business is built around research and chip design, not chip manufacturing, and it outsources almost all of its chip production to TSMC. NVIDIA's success on the operating front has impressed financial markets, and its rise in market capitalization from its IPO days to $1 trillion value. In fact, the company had near-death experiences, at least in market value term, in 2002 and 2008, losing more than 80% of its market value. Professor Damodaran said he owes his lucky run with Nvidia to one of those downturns in 2018, when the company lost more than 50% of its market value. So, it is important to remember the lesson that even the biggest winners in the market have had periods when investors have turned intensely negative on their prospects, making them attractive as investments for value-focused investors. From promise to profits. Since AI has become such a powerful market driver, it is worth looking at the past for guidance on how it will play out for investors and businesses. Thinking about where AI falls on the spectrum from revolutionary to incremental to minimalist change? A year ago, Professor Damodaran would have put it in the incremental column, but ChatGPT has changed his perspective. That was not because ChatGPT was at the cutting edge of AI technology, which it is not, but because it made AI relatable to everyone. His wife, who teaches 5th grade, grappled with students using ChatGPT to do homework assignments. His students asking ChatGPT questions about valuation that they would have asked him directly. The potential for AI to upend life and work is visible, though it is difficult to separate hype from reality. The revolutionary changes of the last 4 decades have created winners within space. But a few caveats have also emerged. First is that these changes have given rise to businesses where there are a few big winners, with a few companies dominating the space, and we have seen this paradigm play out with software, online commerce, smartphones and social media. Second is that the early leaders in these businesses have often fallen to the wayside and not become the big winners. For investors, the lesson has to be that investing in revolutionary change, ahead of others in the market, does not translate into high returns. If you back the wrong players in the race, or more importantly, miss the big winners. It is true that at this very early stage of the AI game, the market has anointed Nvidia and Microsoft as big winners, but it is entirely possible that a decade from now, we will be looking at different winners. The bottom line is that even if we all agree that AI will change the way businesses and individuals behave in future years, there is no low-risk path for investors to monetize this belief. Stay tuned for part 2 of this video, in which we will cover the remaining section on Nvidia valuation.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors. Thanks for watching.